Welcome to The Explainer. I am so excited to get into today's topic with you all. We're going to dive deep into how bookkeeping takes everyday, seemingly mundane transactions and turns them into a crystal clear financial story. Whether it's buying a quick coffee, paying the rent, or selling a massive software package, there's a really fascinating narrative hidden right beneath the surface. Okay, let's dive right into this. You know, every business, from the little local bakery down the street to the biggest tech giant, has a story. And this quote perfectly captures our core metaphor for today. Tracking finances isn't just about crunching numbers or doing math. It's literally writing the chapters of a business's story, line by line, transaction by transaction. So here's our roadmap for The Explainer. We're going to hit 5 key areas: the financial story, bookkeeping versus accounting, the accounting equation, the paper trail, and finally, the digital era.
All right, part 1, the financial story. Understanding the basics.
Before we can actually read the financial story, we kind of have to meet our cast of characters. Fundamentally, what exactly is bookkeeping? Well, it's the process of collecting and keeping a detailed, highly accurate record of every single financial transaction in a business, right as it happens. Think of a bookkeeper as the essential record keeper. Every time the business earns a dollar, pays a utility bill, or buys stock, the bookkeeper is right there to write it down. They're capturing the raw events of the business in real time.
Moving on to Section 2, Bookkeeping versus Accounting, the record keeper versus the analyst.
Now it's time to clarify 2 terms that constantly confuse people. And while they sound super similar, they actually do 2 very different jobs. Bookkeepers gather the facts. They're in the trenches dealing with the initial collection and recording of daily data. Accountants, on the other hand, well, they take over once that data is already recorded. They interpret what those facts actually mean for the future of the business. They prepare statements and guide decisions. But here's the thing. You absolutely cannot have the analyst without the record keeper laying that solid foundation first.
Which brings us to Section 3, the accounting equation, the scales of business.
This equation is the foundational rule that honestly keeps the whole system from falling apart. Let's break down its parts, starting with assets. These are simply the things the business owns that have value. You know, the good stuff that helps the business run. Cash sitting in the bank, physical property, the computers on the desks, or even the ovens in a bakery. Basically, if it has value and the business owns it, boom, it's an asset.
Then, in total contrast to that, we have liabilities. These are the things the business owes to others and eventually needs to pay back. Think of this as the business's debts and obligations. A £50,000 bank loan? That's a liability. An unpaid invoice for office supplies? Yep, also a liability.
And finally, we have owner's capital, which is also known as equity. This represents the owner's personal slice of the pie. It's the actual amount of money the owner directly puts into the business, either to get it off the ground initially or to keep it running during tough times.
So, the crucial takeaway here is that these 3 elements come together to form the accounting equation. Assets equals liabilities plus owner's capital. And this equation is exactly like a set of scales that must always remain balanced. For example, let's say your bakery buys a £1,000 computer on credit. You gain a new asset worth £1,000. But because you haven't actually paid for it yet, your liabilities also increase by £1,000. Both sides go up equally, and the scales stay in perfect harmony.
And that brings us to the famous duality principle, or double-entry bookkeeping. Every single transaction affects 2 accounts. It's a dual impact. The left side is for debits. This increases what the business owns or spends, like your assets and expenses. The right side is for credits. This increases what the business owes or earns, like liabilities or income. Every debit absolutely must have an equal credit. That is the magic rule that guarantees our equation stays balanced.
All right, let's move to Section 4, the paper trail, tracking the journey.
Let's look at how this actually happens in the real world. How does a single purchase transform into a line in a ledger? Well, it follows a clear chronological workflow. Step 1, it all starts with documents. An invoice or a cash receipt proves that an event actually happened. Step 2, that document is recorded in the books of prime entry, like a sales day book or a cash book. It's the very first place it gets written down. And Step 3, finally, it flows into the general ledger. This is the master book where all those transactions are summarized and categorized to show the overall financial position of the business.
Let's see how this builds by looking at the 2 massive, distinct flows of money that every single business stands between. On one side, you've got receivables. This is money customers owe you for goods you've already sold them on credit. It's money coming in. On the exact opposite side, you have payables. This is money the business owes to its suppliers for goods it bought on credit, so that's money due to go out. Managing these two flows effectively is, without a doubt, the absolute lifeblood of a healthy business.
Which leads us to our final section, Part 5, the digital era, modern software systems.
Let's bring this into the 21st century because, let's be honest, keeping giant physical paper ledgers is largely a thing of the past. Today, modern bookkeeping relies on powerful tools like QuickBooks Online. This transitions everything we just learned about manual ledgers straight into automated software. It handles the sales cycle and the expense cycle seamlessly, but perhaps its most vital function is bank reconciliation. This is the ultimate accuracy check. It ensures that the software's digital records perfectly match the real-world bank statements, so absolutely nothing is missed or duplicated.
In this digital environment, the organizational backbone is something called the chart of accounts. You can think of it as a brilliantly designed postcode system for your finances. Every single account gets its own unique location number, or code, so the software can group totals instantly and keep the whole shebang perfectly organized. In practice, this postcode system is incredibly efficient. Assets might be assigned to the 1000s, equity in the 3000s, and administrative expenses in the 7000s. So instead of a human typing out office rent every single time a bill is paid, a bookkeeper simply inputs code 7000. The software immediately knows what it is. It keeps the data entry lightning fast, highly consistent, and completely ready for automated reporting.
And all of this meticulous tracking, coding, and balancing, it all culminates in two critical reports that reveal the absolute health of the company. First, the profit and loss statement tells you the story of your operations. Did your income actually beat your expenses? Did you make money? Meanwhile, the balance sheet gives you a snapshot in time. It takes that accounting equation we learned earlier and shows your exact position regarding assets, liabilities, and equity on any given day.
Let's bring it all together with a really concrete example. Imagine our small bakery again. Through careful bookkeeping, they tracked that they brought in £1,000 in income from selling bread. But they also tracked £700 in expenses for flour, rent, and wages. That leaves us with this crucial bottom line number, £300 in profit. This single number proves exactly why bookkeeping is so vital. It transforms a chaotic mess of receipts into a clear, actionable fact about the business's success. Which leaves us with this final, vital question. What story are your business's numbers telling? Are they telling a story of chaotic, out-of-control expenses, or a story of balanced, profitable growth? By understanding the basics of assets, liabilities, and double-entry tracking, you can actually take control of that narrative. I really hope this explainer has motivated you to harness the true power of bookkeeping for your own ventures. Thanks so much for joining me today, and keep learning.